Most people think the Federal Reserve is a building far away from their lives. That is a mistake. The Federal Reserve lives inside your mortgage payment. It lives inside your savings account. It lives inside the price of a house, the cost of a car loan, the value of your paycheck, the interest on government debt, and the number on your brokerage statement. When the Federal Reserve changes the price of money, it changes the price of almost everything built on top of money. That is why a new leader at the Federal Reserve matters. It does not matter because one man is magical. It matters because every major monetary cycle creates winners and losers. The people who understand the cycle early are rarely the people arguing the loudest on television. They are usually the people studying history, debt, inflation, asset prices, and where the incentives force policy to go next. America is now facing a debt problem that cannot be ignored. The number is roughly $39 trillion. That is not a normal household number. It is so large that most people stop thinking clearly when they hear it. But the number matters because debt is not just a number on a government website. Debt has interest. Interest becomes spending. Spending requires taxes, borrowing, or money creation. And each one of those choices eventually comes back into the life of the ordinary citizen. The question people are asking is simple. Will the new Fed leader listen to political pressure and cut interest rates? Or will the Fed keep rates high? Because inflation is still a problem. That is the wrong first question. The better question is, what has the Federal Reserve done in the past when the system was under pressure, and which assets benefited when it made those decisions? History does not repeat perfectly. It never does. But human incentives repeat, government debt repeats, inflation fear repeats, the temptation to print money repeats, the punishment for holding only wages and cash repeats, and the advantage of owning the right assets at the right point in the cycle repeats more often than people want to admit. Over the last 50 years, there have been three major Federal Reserve cycles worth studying. The first came in the late 1970s and early 1980s, when inflation was the enemy. The second came after the 2008 financial crisis, when the banking system and housing market broke. The third came after the 2020 pandemic, when the economy was shut down and money was created at a scale that would have sounded impossible in an earlier generation. Each cycle taught the same basic lesson in a different language. The worker who depends only on wages usually falls behind. The saver who does not understand inflation can lose purchasing power even when his account balance looks safe. The investor who understands the direction of money can become much wealthier, sometimes dramatically wealthier. Let us begin with the late 1970s. Inflation was raging, prices were rising, people felt the dollar weakening in their daily lives. The Federal Reserve eventually responded by raising interest rates aggressively. Rates went to levels that would shock people today. Short-term interest rates moved toward the high teens and even around 20%. That kind of policy is painful. It is supposed to be painful. When a central bank raises rates aggressively, it is trying to slow demand, punish excessive borrowing, and defend the currency. It makes mortgages expensive. It makes business loans expensive. It makes speculation harder. It can hurt employment. It can make people angry. But if inflation is running out of control, the alternative can be worse. During that period, inflation over several years was very high. Wages rose, but wages did not fully keep up with the rising cost of life. That is an important pattern. A person working for a paycheck may see the paycheck increase and still become poorer because groceries, energy, housing, and everything else rise faster. Nominal income is not wealth. Real purchasing power is what matters. During that cycle, the people who did well were not necessarily the people chasing speculative assets. When interest rates are extremely high, cash and bonds can become powerful. If you can earn 15% a year lending money to a highly reliable borrower, that is a very different world from a zero-rate environment. In that period, people holding cash, like instruments and long-term bonds at high yields, could do quite well relative to inflation. That sounds strange to people trained by the last 15 years of low rates. But in a high-rate world, cash is no longer trash if the yield is high enough and inflation begins to come down. This is why you cannot use one investment rule for every environment. A man who says stocks always win in every 5-year stretch is wrong. A man who says cash is always safe is also wrong. A man who says gold always protects you is wrong too. Assets behave differently depending on the monetary cycle. In the late 1970s and early 1980s, the Fed was fighting inflation by making money expensive. That rewarded the people who could earn high interest without taking foolish risk. It punished people whose wages lagged inflation. It punished borrowers. It punished the careless. Then came 2008. The housing market collapsed. Banks were in trouble, credit froze. People discovered that a system built on easy lending, rising home prices, and complex financial products could break very quickly when confidence disappeared. The Federal Reserve responded in the opposite way. It cut interest rates and created money to stabilize the system. This was not the late 1970s. The problem was not that the economy was too hot. The problem was that the financial system was in danger of freezing. When the system freezes, the central bank tries to create liquidity. It lowers the cost of money. It pushes investors out of safe assets and into risk assets. It tries to make people borrow, invest, spend, and believe again. Over the next several years, the people who owned assets benefited enormously. Stocks rose dramatically from the bottom. Real estate recovered and moved higher. Gold rose as people worried about money printing and the value of the dollar. Meanwhile, wages did not keep up in the same way. Again, the person relying only on a paycheck was not the main winner. The asset owner was. This is the second lesson. When the Fed cuts rates and creates money, it usually helps financial assets first. The new money does not reach every person equally. It enters through banks, institutions, markets, credit channels, government programs, and asset prices. Stocks can rise before wages rise. Real estate can become more expensive before paychecks catch up. Gold can rise because people fear currency debasement. The asset owner sees wealth, the wage earner sees prices. That is not a small difference. Then came 2020, the pandemic hit, the economy shut down, and the Federal Reserve cut rates to extremely low levels. Money was created aggressively. Government spending exploded. Liquidity rushed through the system. People received checks. Businesses received support. Markets were rescued. Interest rates went near zero. The result was extraordinary. Stocks surged. Real estate prices surged. Gold rose. Bitcoin exploded. This was the most vivid modern example of how low rates and money creation can push investors toward risk. When money can be borrowed cheaply, every institution starts asking where it can earn a return. If you can borrow at very low rates, a 5 or 6 or 7% return can justify large investments. When safe yields are low, capital moves outward into stocks, real estate, venture capital, crypto, technology, private markets, and speculative assets. This is why speculative assets often boom when interest rates fall and liquidity rises. It is not because every speculative asset suddenly becomes a good business. It is because money becomes easier, risk appetite rises, and investors look for upside. Bitcoin benefited from that environment because it sat at the intersection of speculation, distrust of currency, scarcity narrative, and abundant liquidity. It moved from thousands of dollars to levels far higher as institutions and individuals looked for assets outside the traditional dollar system. Again, the lesson was not that every person became richer. The lesson was that asset owners gained far more than wage earners. Inflation rose after the pandemic, wages rose too, but for many people, the cost of life rose faster than income. Housing became less affordable, cars became more expensive, food, insurance, energy, and services all pressured households. The person who owned assets watched nominal wealth rise. The person who owned only a paycheck watched life become harder. That brings us to 2026. The United States now sits in a very uncomfortable position. The debt is enormous. The debt to GDP ratio is around levels not seen since the period around World War II. Inflation is still a concern. Oil prices and geopolitical conflict can push prices higher. At the same time, parts of the economy can weaken under the weight of high rates, expensive debt, and slowing demand. That is a difficult combination. If the Fed cuts rates, it may help the economy and markets in the short run, but it can make inflation worse and weaken confidence in the dollar. If the Fed keeps rates high or raises them, it may fight inflation, but it can put more pressure on borrowers, businesses, consumers, and the government itself. This is the problem. The Fed is not choosing between good and bad. It is choosing between different kinds of pain. That is why the new leader matters. President Trump wants lower interest rates. That is not surprising. Presidents almost always prefer cheaper money because cheaper money can support markets, real estate, business activity, and political optimism. But the Federal Reserve is supposed to consider inflation, employment, the stability of the currency, and the credibility of the institution. A Fed leader who cuts too easily risks inflation. A Fed leader who stays too tight risks recession and debt stress. This is the bind. When the country has $39 trillion of debt, the bind becomes more dangerous. Think about a household with too much debt. If interest rates rise, the monthly payment becomes heavier. If income does not rise fast enough, the household must cut spending, earn more, refinance, or default. A government has more tools than a household. It can tax, it can borrow, it can roll over debt, it can influence money creation, but it still cannot escape arithmetic. Interest payments on the debt become a larger and larger part of the budget. More tax dollars go toward paying yesterday's borrowing instead of today's services. That creates political pressure. Cutting spending is unpopular. Raising taxes is unpopular. Default is unthinkable in normal political language. So the path of least resistance often becomes borrowing more and creating more money. That is why investors must study this carefully. If the debt problem forces easier money over time, assets can rise in nominal terms. Stocks, real estate, gold, Bitcoin, and other hard or scarce assets may benefit because the measuring stick, the dollar, is being weakened. But if inflation becomes too painful and the Fed must keep rates high, then cash, short-term instruments, and certain bonds can become more attractive, at least for a time. The correct answer depends on the cycle. No single asset wins every environment, but the wrong position is usually being financially uneducated, holding only wages, ignoring inflation, and reacting after the move has already happened. That is how most people lose. The broad stock market is one of the simplest ways to stand on the asset owner side of the system. A fund tracking the S&P 500 gives exposure to large American companies. A total market fund gives exposure to thousands of public companies. A NASDAQ 100 fund gives more exposure to large non-financial companies, especially technology and related businesses. Broad stocks have done well over long periods because productive companies adapt. They raise prices, they sell more, they cut costs, they innovate, they return capital, they participate in the nominal growth of the economy. When the currency weakens over time, the revenues and earnings of strong businesses can rise in dollar terms. But stocks are not safe in the short term. They can fall sharply, they can stay down longer than people expect. A person who buys stocks must be willing to live through volatility. The broad market has survived many crises, but it has punished people who panic at the wrong time. That is why broad investing requires patience. If you cannot handle declines, you will not earn the long-term return. Real estate is another major asset class that has survived many monetary cycles. Physical property can benefit from inflation because replacement costs rise, rents can rise, and fixed rate debt can become easier to repay with cheaper future dollars. Rental properties can produce cash flow. They can also provide tax advantages, leverage, and long-term appreciation if bought correctly, but real estate is not effortless. Bad debt, bad tenants, bad locations, bad insurance markets, rising property taxes, poor management, and overpaying can destroy the promise. A rental property is a business. Treat it like one. For people who do not want physical property, real estate investment trusts can provide stock market exposure to real estate. REITs often pay dividends because they distribute much of their taxable income. Broad REIT funds can give exposure to many types of properties, but REITs trade like securities and can fall with markets, especially when rates rise. So again, the tool depends on the person. If interest rates fall, liquidity returns, speculative assets can become more attractive. Bitcoin is one example. Some investors own it because they view it as digital scarcity or a hedge against fiat debasement. Others own it because it can behave like a speculative risk asset when liquidity rises. Both ideas have appeared at different times. If rates fall and money becomes easier, assets like Bitcoin can move sharply because capital is searching for high upside, but volatility is enormous. A person should not confuse possible upside with safety. Bitcoin can rise dramatically and fall dramatically. If you own it, you should know why. Size it carefully and be prepared for extreme moves. Growth funds are another way to express a lower rate environment. Companies with profits far in the future often benefit when discount rates fall. If interest rates come down, the present value of future growth can rise. Funds focused on growth companies or disruptive innovation may do well in easy money periods, but the reverse is also true. When rates rise, speculative growth assets can collapse because distant profits become less valuable and funding becomes harder. This is what investors saw when interest rates moved higher after the easy money period. The same assets that soared under low rates were punished under high rates. So a growth or speculative allocation must be treated with respect. It is not the foundation for every investor. It is a risk sleeve. If inflation is the bigger worry, other tools enter the conversation. Treasury inflation, protected securities, often called TIPS, are government securities whose principal adjusts with inflation. They can help protect purchasing power under certain conditions. They are not perfect. Their market prices can move, and the real yield matters, but they are built specifically to respond to inflation as measured by the government. Gold is another inflation and confidence hedge. I do not think of gold as a productive business. It does not produce earnings. It does not pay rent. It does not innovate. It just sits there. But sometimes that is exactly why people want it. Gold is outside the promise of a corporation or the credit of government. In a way, many financial assets are not. People often buy gold when they fear money printing, currency weakness, financial instability, or geopolitical stress. Gold can rise dramatically during fear and then disappoint when fear fades. It can go through long periods of underperformance. It is not a magical solution, but as a store of value or insurance-like asset, it can have a place for some people. The point is not that one of these assets is always right. The point is that different Fed cycles reward different assets in a high-rate inflation. Fighting cycle, cash and bonds can regain value. In a rate-cutting liquidity cycle, stocks, real estate, gold, and speculative assets can boom. In a debt crisis where policymakers lean toward devaluing the currency, productive assets and scarce assets may protect purchasing power better than wages and cash. In a deflationary panic, liquidity becomes priceless. A wise investor does not need to predict perfectly. He needs to understand the range of outcomes and avoid being exposed to only one version of the future. That is why diversification matters. Not the lazy kind where you own 20 things that all depend on the same cheap money trade. Real diversification, some productive businesses, some liquidity, some real assets, some inflation protection, some optional exposure to upside if it fits your risk tolerance. A plan that can survive either a stubborn Fed or an easy Fed. The mistake most people make is waiting for certainty. They want to know exactly what the Fed will do before they act. But by the time certainty arrives, the market has often moved. Asset prices change before the newspapers explain why. Markets are discounting machines. They are constantly trying to price the next policy move, the next inflation reading, the next debt problem, the next injection of liquidity. You do not need to outguess every meeting. You need a financial structure that is not destroyed by the meeting. The broad lesson from the last 50 years is hard but clear. People who relied only on wages generally lost ground to inflation. People who owned the right assets became wealthier. The specific winners changed by cycle, but ownership mattered again and again. That does not mean everyone who buys assets wins. Plenty of investors buy the wrong assets. Overpay, use too much debt, panic sell, chase speculation, and lose money. Ownership must be intelligent, but being only a worker and saver in an inflationary debt-heavy system is dangerous. A paycheck is taxed. A paycheck is diluted by inflation. A paycheck stops when you stop working. Assets can work while you sleep. Assets can rise with inflation. Assets can produce income. Assets can be passed on. Assets can put you on the side of the system that benefits when money is created. That is why financial education matters so much right now. If the Federal Reserve cuts rates and liquidity returns, you need to understand why speculative assets may rise, but also why they can collapse later. If the Federal Reserve keeps rates high, you need to understand why cash yields and bonds may matter again, and why highly leveraged assets may struggle. If inflation remains stubborn, you need to understand why wages may not keep up, why hard assets may attract demand, and why government debt becomes more expensive. If the debt crisis worsens, you need to understand why policymakers may prefer inflation over explicit default. None of this is theoretical. It touches your grocery bill, mortgage rate, retirement account, property value, job market, and taxes. The ordinary person waits until the pain arrives. The investor studies the mechanism before the pain becomes obvious. Now, there is another discipline required here. Do not become a fanatic for any one asset. Some people worship stocks, some worship real estate, some worship Bitcoin, some worship gold, some worship cash. Worship is dangerous in finance. Every asset has a season. Every asset has weaknesses. Every asset can be overpriced. Every asset can disappoint. The intelligent investor asks, what job does this asset do in my plan? Stocks are for participation in productive enterprise and long-term growth. Real estate is for cash flow, inflation linkage, and tangible ownership if bought well. Cash is for liquidity, safety, and opportunity during stress. Bonds can provide income and stability, especially when yields are meaningful. Gold can serve as insurance against currency and confidence problems. Bitcoin can serve as a speculative scarcity asset for those who understand the risk. TIPS can offer inflation, link government income, growth funds can provide upside when liquidity is loose, but they require emotional strength. Each tool has a job. Problems begin when people ask one tool to do every job. Hammer is useful, it is not a kitchen. The coming Fed cycle may make some people very wealthy. That is not because the new Fed leader will deliberately choose winners. It is because policy changes the price of money, and the price of money changes asset values. If rates fall, capital searches for return. If rates rise, capital demands safety and income. If inflation persists, hard assets attract attention. If debt stress grows, policymakers may choose paths that weaken the currency and boost nominal asset prices. The people who understand this will be prepared. The people who do not will argue about politics while their purchasing power changes underneath them. I do not want you to be in that second group. So what would I do? I would own productive assets broadly enough that I do not depend on one company or one prediction. I would keep enough liquidity so I'm not forced to sell during fear. I would avoid high interest debt because it makes me weak in every environment. I would understand my exposure to interest rates. I would not buy speculative assets with money needed for safety. I would use inflation hedges as hedges, not religions. I would watch the bond market because it often tells the truth before politicians do. I would study what the Fed does, but I would not let every meeting control my life. I would think in probabilities, not certainties. The Fed may cut, the Fed may hold, the Fed may talk tough and then ease later. Inflation may force discipline, debt may force devaluation, markets may boom first and crash later. Markets may crash first and boom later. No one knows the exact path, but history says something very clear. In every major monetary cycle, money moves, it moves towards certain assets and away from others. It rewards some behaviors and punishes others. It quietly separates owners from workers, prepared investors from late reactors, and people who study from people who guess the debt crisis is not just a Washington problem. It is a personal finance problem. It will influence taxes, inflation, interest rates, asset prices, and opportunity. You cannot vote your way out of needing a plan. You cannot complain your way into wealth. You cannot save your way through every inflationary cycle. If your savings do not earn enough, you cannot borrow recklessly and expect the Fed to rescue. You personally, you must understand the game. The game is not fair, but it is visible. When rates are high, money has a price. When rates are low, speculation has fuel. When debt is too large, currency weakness becomes tempting. When inflation rises, wages often lag. When money is printed, asset owners usually stand closer to the front of the line. Once you know that, you have a choice. You can stay only in wages and cash and hope the system treats you kindly, or you can become an owner, a student of money, and a person prepared for more than one outcome. I know which side I would rather be on. The next Fed cycle is coming one way or another. The question is not whether it creates winners. It will. The question is whether you have studied enough, prepared enough, and positioned yourself carefully enough to be one of them without letting greed destroy you first. That is the real work. Not predicting every headline, understanding money before the headlines explain it too late, and making sure that whatever the Federal Reserve does next, you are not standing there with only a paycheck, a savings account, losing purchasing power, and no claim on the assets that move when the money changes direction. Because when the price of money changes, wealth changes hands. It always has. And it will again